Well, with me now in the studio is Dr. Henning Mayer, who's a senior visiting fellow at the London School of Economics. Thank you very much for being with us. I mean, this is still unravelling, isn't it? We don't know where the end of this is.
No, I mean, as Manuel Barroso said, it's entering a new phase. The meeting that we had last month, on the 21st of July, that supposedly put a stop to it, actually hasn't. So we're still seeing the situation unravelling.
It's not overdoing it, is it, to use the word crisis?
No, certainly not. I mean, it's a crisis of many different drivers, I would have to add. I mean, to my mind, one of the key problems is that there is no expectation of growth anywhere really in the so-called crisis countries. You know, without generating any economic growth, it's very difficult to see any measure that could turn that trend around. So growth seems to me pivotal, but nobody's talking about it.
The confirmation of the current low-for-long policy, which will be done through a verbal signal. I expect them to tell us in more detail what their own expectations are for interest rates, to give us a more detailed forecast for interest rates. They've given us some verbal signal in their statements, but to actually give us some numbers when they present their forecast, tell us what their assumptions about policy are. I'm not expecting a quantitative easing, another QE3, if you will, unless the economy clearly begins to soften. I think growth is looking to be at or a bit above trend, and inflation is still high enough that deflation is by no means anywhere near the concern that it was when they engaged in QE2. So the picture is going to have to change for the U.S. economy fairly significantly, it would be my sense, before we got to a QE3.
Would you call this an important short-term event, Peter, or a game changer in terms of managing the euro crisis? What happened last?
In Greece, the political turmoil is over that nation's crippling debt crisis. It sparked violent protests, and this morning, the embattled prime minister kicked off a broad cabinet shuffle to counter the widespread anger. CNBC's Michelle Caruso-Cabrera is in Athens this morning. Michelle, good morning.
Good morning, Anne. And Greece finds itself squeezed between international creditors and a very angry Greek public. They did reshuffle the cabinet this morning, all in an effort to get a budget passed to try to keep this nation afloat. They do have a new finance minister, but it seems a lot of Greeks have lost patience altogether.
Very good evening to you, Patrick.
Good evening.
Just this weekend, financial advisors to the German government reportedly admitting the EU rescue fund won't be enough to save Italy if it slips into crisis. Now, it's the EU's third largest economy. If it does default, what then?
Well, look, I mean, what the Germans have said is just something that we've all been saying for months and months and months, but nobody wanted to realistically appreciate. Let's try and understand the size of the numbers here. The Italian government owes 1.8 trillion euros. Now, that means nothing to anybody, but that is bigger than the total government debt of Ireland, Portugal and Greece put together. Before the end of this year, Italy needs to sell bonds, debt, which is equivalent to the whole of the Greek government bond market. In other words, all of the Greek debt that we've been talking about for weeks and weeks and weeks as being a huge crisis. Italy is huge. It is just too big to manage to, in any way, be rescued in the way that other economies have so far been bailed out by the EU.
So if the worst does happen, what you're saying is Italy's too big to rescue. Well, hang on a minute. It's always easy to talk with hindsight, I suppose, but wasn't it too big to be accepted into the Eurozone club in the first place if it was ever too big to rescue? How did they invite it in?
Well, this is the appalling thing that happens when politicians get involved in finance. Because actually, Italy should never have been able to join the euro in the first place because it owed far too much money. But ultimately, the rules were bent and changed, and people allowed things to be fudged on the application forms, just as they did with Greece, incidentally. And ultimately, they were able to say the euro is a political success. And the problem now is the hard-headed economic reality has finally reared its ugly head. The markets are scared, and actually, we have no political leader who's actually willing to admit just what a crisis we're in at the moment.
Well, we're hearing, just got some news coming through, in fact, that Germany and France are urging, quote, complete and speedy implementation of Italian and Spanish reform measures. Quite what that means. It sounds great, but whether that's going to calm people down tomorrow morning remains to be seen. I mean, they want some collective decision, EU central bankers, don't they, about Italy before the markets open, but previous game plans haven't really come to anything. They didn't stop the stocks plunging. What do you think they can come up with this time to avoid panic tomorrow?
Well, look, the situation is there will probably be a modicum of panic tomorrow, unfortunately, come what may. But actually, what the Eurozone needs to do is completely rethink the approach that they currently have. They need to consider the idea that perhaps they should look at the idea of reworking the existing debt in the system. Perhaps there are ways around that we can restructure these markets. The difficulty is that the governments have been too slow to react. Now what you're seeing is, I mean, these announcements coming over the wire from Germany or France are basically tacitly saying, we can't rescue you, you're in your own hands, effectively, Italy, you've got to do something. And ultimately, the latest issues that Mr. Berlusconi has come up with, where he's going to save, I think, sort of 48 or 50 billion a year, and he's going to balance the budget in a couple of years' time, and somewhere over the horizon everything will be sweetness and light, is just not enough to be going on with. So what happens tomorrow at the market open? I think very simply we're going to see an incredible amount of volatility, although at the same time I suspect that there may be a more muted response from the American downgrade, because to be quite frank, it's been so widely discussed for so long that perhaps the impact on the American Treasury market won't be quite as acute as we might have expected. That said, we're in for a very exciting day.
Back to Europe, though, where does the crunch come? How long can the talking go on? I mean, there's major disagreement among EU leaders about what to do. They're talking about expanding the rescue fund, buying the government bonds of indebted states, thinking about Italy. But, you know, when is crunch time here?
Well, look, I mean, at the moment, the can is being kicked down the road. Just before we came on air, we've obviously seen the European Central Bank coming out with an announcement saying that effectively they're going to be buying the bonds of Italy and Spain in the open market tomorrow to try and make things better. Now, actually, there's no real economic proof that this ultimately works. But that at least means they can probably hold things together until September, when most of the politicians come back. But realistically, without actually a completely new approach, sometime by September, October, or maybe November, we are in severe danger that the Eurozone is going to collapse.
Because